What are your plans and what are your goals for this year?
Right.
Because there's so many things you can do before December 31st.
Right.
We have clients right now that we're helping with some tax planning strategies and things that they can do before the end of the year to really reduce their tax liability. Because once December 31st comes and goes, you might as well go to H&R Block or just go plug in numbers with TurboTax.
Yes. Welcome to Inside Out. This is James Catledge, your host. We're glad you're here. Today is a unique episode. We're getting in today to money and taxes. It's that time of year. It's the end of the year and everybody's thinking about it. And for many of you who are employed perhaps by someone else, they've been taking from your paycheck all year long and you've seen less money coming home. And you're maybe happy about the election, maybe not, but it looks like more money may be coming to those paychecks based on this last election. Well, I've got an expert today in-house. This is a friend of mine, Brent Carlson, who is the president and CEO of Corporate Capital. I just want to welcome you to the studio. Welcome.
Thank you so much. Thanks for having me. I appreciate it.
Yeah, I'm so glad you're here. This is a subject that this stumps all of us. And I'd like to, if I could, I want to give the audience a little history.
Okay.
On taxes. Can you and I agree that it's the law of the land that we're required to pay taxes?
Yes.
Yeah. There's no way around that.
No, unfortunately, but there's ways to minimize it.
Right. And that's really where your expertise comes in, how to lower the tax obligation. I want everybody to understand that you guys have probably heard of the Boston Tea Party and the Redcoats and John Adams defending the guys who, shot one of the Redcoats, and we've all seen the movies, and we know that Boston Tea Party story. Well, that's about taxes. That whole story is about people feeling improperly taxed by their government. And right now while we're recording this, there's a debate happening back in D.C. about the Department of Government Efficiency and these spending habits, and that's our money. They're spending our money, and we don't like the way our government spends our money. And so it's understandable that people feel bad about actually having taxes to pay and that it's not being handled properly. Well, today, Brent, we're not going to get into the Department of Government Efficiency, but I wanted the audience to know that it's okay to not feel great about having a tax obligation.
Yeah.
Everybody kind of feels that way. They want to minimize it.
Absolutely.
Would you say it's lawful to minimize your tax obligation as long as you're using the Internal Revenue Code?
Absolutely.
That I shouldn't be worried about that.
Absolutely, as long as you're doing it correctly.
Right. And by correctly, you mean according to the Internal Revenue Code?
Correct.
Right. Tell us a little bit about your firm, Corporate Capital. Give us a sense because I know you do a lot of stuff there. You form companies. You help people decide, how to protect those companies. There's lots going on there.
Yeah. So my wife and I set up Corporate Capital with a couple partners back in 2013. So we just celebrated our 11-year anniversary on December 1st.
Congratulations.
We specialize in setting up corporations and LLCs in all 50 states.
Okay.
There's a uniqueness there. You can incorporate in any state regardless of where you live.
Okay.
We also have a full accounting, bookkeeping, CPA firm. So we do everything from reconciliation, basic bookkeeping, accounting, tax planning strategies.
All right.
And then our third piece is estate planning. We do a lot of asset protection trusts and a lot of revocable living trusts.
Okay.
And what's really unique and what excited my wife and I when we started the company was to just keep all that under one roof.
Right.
So when they're looking at these things and their asset protection and paying their taxes, they're not calling their CPA over here and their attorney over here. They're keeping it all under one roof, and that was our vision.
Well, it's funny you say that. I was just thinking to myself how many people I have involved in my business.
Yeah.
And it's not under one roof. There are multiple phone calls to make.
Yeah.
And quite often they need to talk to each other.
Correct.
It's nice having it under one. I love that idea. Well, let me ask you just a couple of basic questions that would be good for me and the audience to hear. What is an LLC? What is that?
So an LLC is a limited liability company.
Okay.
So when you go into business, a lot of people will start off as a sole proprietorship.
Okay.
Whether it's consulting or Etsy or doing things on the side.
Okay.
But when you do that, as a sole proprietorship, you're taking on all of that liability.
Okay.
So when you set up a limited liability company, you are now separating yourself personally from that business.
Okay.
So if something happens in that business, they can't turn around and sue you personally, depending on what state you are incorporated in.
Oh, interesting. Okay, let me ask some follow-up questions there. So LLC stands for Limited Liability Corporation. Limited Liability Corporation. Company.
Yeah.
And so what's limiting about the liability? Let's say I'm an influencer, a social media guy, and I'm making a lot of money with social media. Do I need an LLC, or can I just kind of do it?
Well, absolutely, you need an LLC, not
Okay.
only for the asset protection, in my opinion,
Okay.
but also for the tax advantages. Because if you are doing it under Brent Carlson,
Yeah.
as opposed to an LLC, the only way you can be taxed is a sole proprietorship. So you're paying that 15.3% self-employment tax
Okay.
on all of your money, as
Okay.
opposed to if you have an LLC or even a corporation,
Okay.
you can elect to have that tax as an S corporation,
Okay.
which eliminates that 15.3% self-employment tax,
Okay, hold on. We're doing a lot of math.
which is huge.
We're doing a lot of math.
Yes, sir.
So you're saying that if I'm running a business, and this, let's say I work somewhere else, but I have this ambition of running a business. I'm an entrepreneur. So I set up one of these LLCs that you talk about. You're telling me by running my income through that LLC, like with a bank account and everything else, I deposit into that account and I spend from that account, I can save 15.3% of my tax liability.
Yeah, and let me explain that. So I'm an S corporation with our company. We're a multi-million-dollar company. We have a decent K1 at the end of the year. A K1 for an S corporation is the profits or losses left over at the end of the year.
Okay, from my efforts through that LLC.
Yes. So with my company, I pay myself a reasonable compensation salary. So my salary I try to keep as low as possible, but still competitive.
Is that required?
That is required when you're an S corporation. You have to be an employee of your own company.
Got it.
But let's say you keep your salary around $100,000.
Okay.
Now you're paying the Social Security, the FICA. You're paying all that 15.3% on the salary that you pay yourself.
Okay.
But now at the end of the year, if you're profiting $100,000 in your business and you're a single member LLC or a sole proprietorship, I can tell you and the audience they're paying $15,300 more in taxes per 100,000.
Okay, so it's a complete waste of money, basically, to not have the LLC when I decide to, even if it's a little business, to start it.
Absolutely. And here's why, James, I feel that way, is if you're going to do something on the side and you have these other assets and you're successful and you have rental properties and you're going to do something to give it a shot, it may or may not make a lot of money. So if it does, you want to have the protection. If it doesn't, you want to have the protection. So by having the limited liability company or even a corporation running those endeavors or doing your investments or the consulting or whatever entrepreneurship mentality you have, now you have the protection and they can never sue us personally. And that is what I focus on. I'm very big on asset protection and I'm very big on tax planning strategies.
All right. You use the word member when describing the LLC's owner. Is that the official word? So if you and I have an LLC together, we're members of that LLC?
Correct.
Got it. And so we could start an LLC together and be 50-50, and you'd be a 50% member and I'd be a 50% member.
Correct.
I can't do the S election or the sole proprietor election if I have a second member in that LLC, right?
That's correct. So if we have an LLC and there's more than one member that's not your spouse, then it's either a partnership, which would be a 1065 partnership return. But here's the problem for anyone that has a partnership. I recommend looking into this. You're still paying that 15.3% self-employment tax.
Got it.
So what we would do in that situation is we would elect to be taxed as an S corporation. And then we both would take a reasonable salary from that company. And then at the end of the year, whatever profit we had left over in our partnership, we would save the 15.3%. One thing I want to explain, if I may, is when you set up a corporation or an LLC, you set up either a C corporation or a limited liability company. This election that I'm talking about is an election that's done with the Internal Revenue Service. It's the IRS.
It's a new form you've sent in.
It's a 2553 is the exact form. And we help our clients with that form, and that will allow their entity, whether it's a C Corp or an LLC, that will give them the ability to be taxed as an S corporation.
Got it.
And generally, if businesses are generating 6 figures plus, the S corporation really needs to get a hard look at.
Okay, so I think I followed this, and the example helps me. So we're partners. We did an LLC. We both decided to take these salaries at your suggestion. We're both taking $100,000 each. But there's another couple $100,000 that we've got in profit. Are we K1ing that over to a different LLC?
No, it's just K1s to ourselves.
So me, James Catledge.
James Catledge, Brent Carlson would get a K1.
Got it.
Now we would pay ordinary income tax on that, but we're not paying the 15.3%.
I'm skipping the 15.3. So in this example, it's an extra $100,000 each. We took a salary of $100,000 each. Now there's an extra $100,000 each coming in.
Yep.
So we're just going to take that as a K1 to us personally.
Yep.
Going to hit our 1040.
Yep.
Got it.
And it'll be filed under Schedule E of your tax return.
Okay.
Yes.
And that's skipping the 15.3, which is really what we're trying to dodge here.
Absolutely.
Yeah, that's huge.
And personally, I don't know if Social Security, depending on the age of the audience, I don't know what's going to happen with Social Security in the future.
We don't.
So I'd rather keep it at a minimum, keep the taxes down, and then take most of that in a distribution or a K1 so I can take that and invest it in other areas.
All right. And I'm going to back up just a little bit because we covered a lot of ground. S and C looks like my two options with an LLC. There's an S election and a C election. Am I right?
So believe it or not, with a limited liability company, you can be taxed as a sole proprietorship, which is the same thing as Brent Carlson having a business.
Okay.
But now I have the protection because I have that brick wall of the LLC between me and my business.
And that's the S election?
No, that's just being a single member LLC.
I just set up an LLC.
So if I set up an LLC, James, and I don't do an S election, then I'm always going to pay that 15.3%. So your LLC can be taxed as a single member, which a lot of clients are if their income is a certain amount. You can be taxed as a partnership in an LLC. You can also be an S corporation election. And I personally have an LLC that I have taxed as a C corporation. So to answer your question, your LLC could be taxed any way the IRS allows a corporation to be taxed.
Interesting. So it sounds like the LLC is very flexible.
We do 99 out of 100 companies or LLCs for that reason. Very simple to run and a lot of flexibility.
What would be the 1%?
So when there's foreign investors, and when we do a lot of business, we have clients all across the world. So when if they don't have a Social Security number or if they have foreign investors that are going to be part of the business, it's a lot easier for a C corporation to be in place for that type of business.
Would this apply to shareholders as well? If I'm going to maybe go public one day and file an IPO,
absolutely,
I would want a C corporation.
Absolutely. And this is where we could possibly talk about different states, because when it comes to C corporations that are going public, even though I'm headquartered here in Las Vegas, Nevada, own a building up on the west side towards Summerlin, we do a lot of Nevada, Wyoming, and Delaware formations.
The Delaware would be for the corporation.
Delaware is still the best state for those publicly traded companies.
Interesting.
So I just helped a gentleman here in town that's starting a new kind of a Tesla power plant, and we set up his corporation in Delaware because they have already gone public. They're going through the SEC compliance.
What makes Delaware the venue for that? The jurisdiction? Why is that a good spot?
It's just Delaware and Nevada and Wyoming are very, very similar. But Delaware still, for whatever reason, protects some of the investors in some of those businesses a little bit better than Nevada and Wyoming. But for private businesses, we typically will do Nevada and Wyoming.
Interesting. So Delaware's in the news in the last 12 months because Elon Musk had made a decision that I'll take no income or revenue or profits or bonuses, but if I could get the company's market value to a certain point, I would like the board to approve a $50 billion payout. In other words, the company market value may turn into $1 trillion, but I'd like you to pay me $50 billion for accomplishing this objective. In the Delaware courts, of course, because that's where the jurisdiction for Tesla is, because it's a publicly traded company, they ruled against it. And I think that was shocking to Tesla shareholders who actually wanted their CEO to get that $50 billion.
Correct.
Yeah.
And Delaware, as far as the investors, so a lot of our clients, Our publicly traded companies, we don't deal with a lot of the big ones out there, but even our new startup companies, we will recommend Delaware. We'll set them up there. There still is different protection laws for investors and for these publicly traded companies that Nevada and Wyoming does not offer. And we typically will go over that with the client to determine if Delaware's the best. But Delaware does have a franchise tax. And Wyoming and Nevada does not have any type of tax. So that's why we want to look to see, does Delaware make sense? If you're going to be a publicly traded entity, absolutely, we're going to start you off there. If it's private, we're going to look at those other 2 states, actually.
Let's talk about the other 2 now. Let's talk. We know Nevada. You and I are in Nevada right now doing this podcast. Nevada has always been a place where entrepreneurs come to set up their LLC. Why?
Nevada is very unique. We all know how our city and our state was built, right? Back in the 60s and 70s. Let's say it, right? So it was big to have protection. It was big for these business owners to make sure that they had no personal liability. And so Nevada put statutes in place years and years ago, 50, 60 years ago, where they have what's known as charging order protection first off. So charging order protection, let's say you and I are partners in a business and I go out tonight and get smashed and I get in an accident and I get sued, which we had a pretty high profile case here not too long ago. I can't have the shares of my LLC taken, and now all of a sudden James has a new partner.
I got a new partner
that you don't want to work with because I screwed up. So Nevada protects the shares of the partners, so they can't be taken from them. So you
call that a charging order?
Charging order protection. I would recommend everyone look that up.
Well, that's important right there. I did not know that.
Yeah, charging order protection is available both here in Nevada and Wyoming.
And does that apply beyond a partner? Like, let's just back to our partnership. Let's say we're 50-50 on a thing, and you do get in a car crash. I can see how important that is. I mean, nobody wants to be in business with the winner of a lawsuit, right? Does it apply anywhere else? What about a divorce?
As far as what do you mean?
The charging order. Like you get divorced and your wife's going to get 50% of your assets, but I don't want to be in business with your wife.
Yeah, so at that point, you would just have to financially come to an agreement. And we've actually had that happen. I've had that happen several times this year.
Basically, your estate is who I'm in business with.
Yeah, and the other thing with the charging order protection is someone may even win a lawsuit against the company, and they will get a charging order, and that doesn't mean the company has to sell or liquidate. And so until they do, they get this charging order, and sometimes you have to pay taxes on this phantom income for this lawsuit. So Nevada and Wyoming are so powerful that a lot of people will just drop it because they won't receive funds for years and years, or maybe possibly ever, and possibly have a tax liability to the IRS.
Oh, I see. So every year, let's say I sue this entity, and I'm victorious, and so I'm not. You don't have to dissolve your business to pay me off.
No.
But I may owe taxes on my phantom winnings from the lawsuit.
Yeah, the person that's suing you. It's the wildest thing, and that's why
that is interesting.
And that's why Nevada and Wyoming are so popular. The other reason is we offer privacy here in the state.
We're going to get into Wyoming separately, but let's stay on Nevada. On Nevada.
Okay.
So when you say privacy, you mean anonymity?
Absolutely.
Okay. So let's talk about that for a second. Because the federal government has gotten themselves involved in these businesses recently. And we'll talk about that in a second too, because there's been some changes legislatively there.
With the BOI,
Right. So when you say anonymous, we form our LLC, back to our phantom partnership here. How is that anonymous? We filed it. We filed it with the Secretary of State, I assume. That's how it's official.
Correct.
Is it just not registered somewhere for somebody to look us up?
That's a great question. When we file, Nevada statutes allow nominee service. So on the articles of organization, if it's a corporation, my name is actually listed on hundreds of articles of incorporation here in the state of Nevada.
Your name, because of your business.
Because I am the CEO. I put my name down as the president, secretary, treasurer, and director.
On a LLC, did you set up for me?
Yeah, and then on the LLC, we have a an LLC called Corporate Compliance LLC that we put on public record as the manager. So now the manager doesn't mean it's the member. And everyone watching
There's a difference. Member manager is different.
And everyone watching, if you're looking to possibly set up an LLC, do not set up a managing member LLC.
As the manager.
You want the manager. You want the LLC to be set up to be ran by managers. Otherwise, you're putting on public record. If it says managing member, we're now telling the world who is the member and the owner of the LLC. So please always put yourself as the manager.
Good.
But to go back to your question, so now on the articles of organization, we have our information on there, so the client's name's not on the articles. If
we're talking about corporate capital, a designee on a new LLC setup.
Yes, and corporate setup for privacy purposes. We put our name
really good
on everything, so your name does not have to appear on public record anywhere in the state of Nevada.
Now let's tell the audience why we wouldn't want our name on these records.
You mentioned it. Maybe divorce, maybe a partnership. Like I'm working with company that had a non-compete. It's passed, but he wanted to still remain private and anonymous, as opposed to just being able to type in your first and last name. You can go to the Nevada Secretary of State, search by officer, and every company that I'm associated with, which people could go there right now, type in Brent Carlson. They'll see there's hundreds of companies that I'm listed as the president, and that's where you get the anonymity.
Got it.
And the state allows it, and the statutes of Nevada allow that.
Oh, that is good.
Yeah.
Okay, so that's unique.
Yeah, very unique.
Because we all know silverflume.gov or whatever, we can look up all these LLCs and the members and the managers. So if you're foolish enough to have a Nevada LLC and you've made yourself both manager and member, you're just crazy. Because the state affords you the ability to have a designee.
Correct.
Yeah.
Correct.
And your business is completely set up to do all of that work.
Correct. Do you mind if I explain that?
Please do. Yeah, please do.
Just real quick, because this is important. So when we set up the nominee service, immediately we resign as the manager or whatever president, secretary, treasurer. We immediately resign, do all the meeting minutes, which is all that's required by the state, and then we send those to our clients. They're able to open up the bank account. They're able to go and get a car loan. It doesn't cause them any issues at all. It just gives them that privacy, and a lot of people like the privacy in this day and age.
For sure, we all do. So basically, the resignation occurs in the books, but doesn't occur in the public website.
And Nevada statute, you do not have to report any changes, and only once a year you have to file your list. So we do it once a year, every year.
And resign every year.
And we resign every year, yes, sir.
How about that?
Yeah.
Well, that's brilliant. That's part your ingenuity as a business, corporate capital. That's part your ingenuity using the legislative process to take advantage of it for your clients.
Yeah. Absolutely.
I love that. Okay, now we're going to switch.
Okay.
Wyoming has become in the last decade a place a lot of Nevadans go to set up an LLC. And they don't have to visit there. You can do it online. But why is a Wyoming LLC unique?
So Wyoming, about 10 years ago, adopted the same statutes, basically put in the same legislation in Wyoming that Nevada has. So they have the charging order protection. There's no state or corporate taxes in Wyoming, just like Nevada. So there's no additional taxes that people have to pay.
Got it.
But the reason why Wyoming has become, and we're setting up more Wyoming LLCs for our clients now too, even though we're headquartered here, because Wyoming, the privacy
is better.
There's no one listed on public record, so they don't even list a manager on public record. So now you don't have to worry about having a nominee or having paperwork where I resign.
The resignation does not have to occur in Wyoming because there's nowhere to look it up.
It's natural privacy there in Wyoming.
That's a great way to say it. Natural privacy.
Yes.
Okay. Now we all know, and maybe not everybody knows, but most people who've set up a company know that there needs to be what they call an agent of record. Okay. Can you just give us a little background on what an agent of record is, and then how that fits into maybe services you provide?
Sure. So the agent of record is typically the registered agent.
Okay.
So for your corporation or LLC, and for those watching here in Las Vegas, Nevada, or Nevada, if you live here, you can be your own registered agent.
Okay.
But a registered agent is supposed to be available Monday through Friday between 8 and 5.
Okay.
Because if you ever get served, if they try to bring
mean a
paperwork,
lawsuit or
yeah,
something?
lawsuit.
Okay.
The registered agent will typically receive that on your behalf
Got
then
it.
privately contact you.
I see.
If you're your own agent of record and your own registered agent, your name and address is going to be listed on public record, and all that documentation is going to go to you instead of a company to help you kind of sort through it.
I got you. Well, is there another reason for an agent of record other than lawsuit service?
The reminder,
Registered agent.
So the reminder to do the renewal every year. So
Okay.
as the registered agent, we have a system where 30 days prior to the renewal being due,
Okay.
we contact them and make sure that they know that the renewal in Wyoming or
Okay.
Nevada or Delaware is due, and we do the filing with the state for them as the registered agent.
What's involved in a renewal?
Just simply
Officer changes?
Yeah, just so in Nevada, let's focus on Nevada.
Yes.
You renew your business license
Okay.
and your list of officers.
Okay.
And then just the registered agent service. That's all you have to renew. But
Got
if
it.
you're your own registered agent, then it's just the list of officers, which is $150 in the state of Nevada.
Okay, it's a feed in Nevada.
And then the business license in Nevada is a couple $100.
Okay.
And then we remind you every year to pay that. And
Okay.
then the other thing that my firm decided to do with the registered agent service that a lot of companies don't do is we want to give the consulting. We want to have these conversations. I want to learn more about you. So with that registered agent
Okay.
service, you can call me or any of the consultants or attorneys on staff
Yeah.
and talk to us at any time, and that's part of being a registered agent. So those
it.
are the three main reasons
Okay.
why you would want to have a commercial registered agent as opposed to be your own.
Remind you of the requirements that the state has for your LLC.
And the meeting minutes. Another thing that I forgot to
The
mention.
meeting minutes, yes.
The other thing that I forgot to mention that we do with our registered agent service is we will help with the annual shareholder meetings
Got
or
it.
the director meetings, or if they're an LLC, we'll help them waive those meeting minutes
I
or
see.
actually hold the meeting minutes of the annual meeting.
Got
so
it.
we keep them in compliance. So the registered agent does all that actually. Jim.
I see. Okay, this is good because you can't just be an LLC for the next decade without these reporting requirements.
Correct. Every year.
There's going to be minutes.
Yes.
Yeah. And if it's just me, myself, and I, there's probably not a meeting.
Yeah, you can waive the meeting, but we still encourage you to waive it.
It's
We
gotta be
provide you
documented.
that documentation for that. Yeah.
Right. Because if my LLC is ever evaluated, maybe by a court, maybe I am in a lawsuit, maybe they try to pierce the veil, if you will.
So glad you're bringing
They're
this up.
going to look at these minutes
Yep.
and see, oh, this guy's not done anything in 9 years. He doesn't really have an LLC. We can get right into him personally.
Yep. So they'll take that LLC, the LLC's this microphone, they'll set it to the side and they'll say, James, you were never running your business appropriately. You've never been in compliance. You don't have the support to be a corporation. And they could
Right.
pierce that corporate veil.
And to pierce it means to make me personally vulnerable, and that limited liability is no longer limited.
Correct. And I do want to make sure that this is important to know. Why Nevada and Wyoming are so popular, James,
Yes.
is even with some of this neglectness,
Yeah.
people still can't pierce the corporate veil. So
Okay.
Nevada and Wyoming, unless you're
It's
committing
hard to pierce it.
unless you're committing fraud and they can prove that you were committing fraud,
Okay.
they can't pierce the corporate veil. So that's why these states are so business friendly, because most people don't do their meeting minutes or they overlook these
know.
little
Yeah.
things
Yeah.
and they still have the protection. So
Got it.
yeah.
Yeah, most are not. You know, you say neglect, but it's human nature, right?
Sure,
I mean,
of
it's going to
course.
happen. So having a service like yours becomes really valuable because if I have a tendency to forget stuff like this, you guys have the annual opportunity to remind me, file my waiver, all the things necessary to protect me.
Correct.
Yeah.
Which at that point in time is when I always will talk to them about what are your plans and what are your goals for this year.
Right.
Because there's so many things you can do before December 31st.
Right.
We have clients right now that we're helping with some tax planning strategies and things that they can do before the end of the year to really reduce their tax liability. Because once December 31st comes and goes,
Right.
you might as well go to H&R Block or just go plug in numbers with TurboTax.
Yes, yes.
You really want to have those conversations. So as a registered agent, we're having those compliance legal questions answered throughout the year.
Yeah.
We're talking to them about their taxes and
Yeah.
Are you trying to buy a home? If you are, we probably can't trim as much fat as you want to.
Right.
But if you're not buying a home, and let's trim the fat. Let's implement some of these strategies that will lower your tax liability.
Okay, I'm going to shift. I want to shift into tax liability in just a second.
Okay.
But before we make that shift, I think we want some closure on these reporting requirements that the federal government has recently installed.
Yes.
And then we're going to talk about the case out of Texas that shifted that a little bit recently, which is real recent. But let's give a little background on, you call it BOI?
Yes.
Okay. Tell us what BOI is and how it affects our new LLC.
Absolutely. So BOI stands for Beneficial Ownership Information.
Okay.
So it's part of the Corporate Transparency Act, CTA.
Okay. This is a federal act.
Yeah, so FinCEN, a department that's been around for a long time, is part of the federal government.
Okay.
They enforce the crimes division of the federal government.
Okay.
So it's been around since 2021, but they decided to make it mandatory January 1st of 2024 that anyone who owned 25% or more of an active LLC or corporation in any state,
Okay.
any decision maker for the business, any foreign investors, anyone that's on the bank account must be reported on this report.
Okay. I want to slow down. You just named some very specific things that require you to be on this report.
Yes, sir.
And one of them was makes decisions for the company.
Correct.
So how do you get down to who that is? I mean, it could be 19 people.
Yeah. So like within our company, we have one girl that we've recently made an office manager that we feel we are.
She is the decision maker on all these designees.
She hired our new girl that's up at the front right now because we're growing.
Right.
So because she's able to do stuff like that, she should be
on
this report.
Okay.
But definitely anyone who owns 25% or more.
That's clear.
That's clear as day.
Yep.
If someone's on your bank account, you need to file and make sure their information is on that report.
Okay, so I'm gonna do some follow-up questions on this. Why are they weighing in on the privacy of our LLCs and who owns them and who doesn't? Because we've gone to great extent to kind of create anonymity about our businesses, right? Because some of us think privacy is important, and I know you do. Absolutely. I mean, that's how you feel.
Yep.
So why is the federal government weighing in on this so heavily? What caused this? Do we know?
I do. First off, they're looking for foreign money and foreign
actors, money laundering.
Yes, sir. They're looking for that. They're looking for more people
terrorism.
Because you're not reporting that on your taxes. But if you get $500,000 from someone now in Russia or China, it has to be on this report. So I think they're looking for terrorists. I think they're looking for like pedophile rings, things like that.
If you want trafficking.
Yes. If you want
Interesting.
Now the other side of it, believe it or not, because it's the United States. The other reason is, and there's probably half the audience now that hasn't heard of the BOI report.
Sure.
Most of my clients that have been in business for years and years have no idea about it.
No, it's brand new.
And that's why I think they did it, is because they knew millions of businesses were going to forget to file this report by the end of the year. And there was a $500 per day penalty, up to a $10,000 fine per company, and up to 2 years in prison.
Okay. So we're talking about a reporting requirement that has prison attached to it if you don't do it.
Correct.
Wow.
Yes.
Okay. Now something's occurred in the last week.
That is correct.
Okay. I'm going to tell you what I know about it, and you fix anything I say that's wrong.
Okay.
And maybe enlighten us further. So somehow, some smart LLC owner files a case in federal court in Texas and says, listen, I don't think this reporting is constitutional. I think it's a violation of my rights. And he named all sorts of cases and all sorts of reasons. And the federal courts in Texas ruled in this guy's favor and went beyond ruling in his favor in his case and said there's an injunction on all BOIs nationally until this is dealt with. Right?
That's correct.
So that is in effect. So your clients right now are not required to do their BOI at this moment for January.
That is correct. Because up until this ruling, which was the Friday before last, you had to file it by December 31st.
Yes.
Now, it's interesting we're having this conversation today because on my way down here, I spoke to two of my clients who have already enrolled to have us file these reports for them.
Okay.
And they wanted my opinion on should they file or not. And all the information is like on the tax returns, and,
Sure.
and I don't have anything to hide. You don't have anything to hide. None of us have anything to hide. So I tell people, I think you still should go ahead and file it because it's free.
Yeah.
Unless you have a company help you do it, but it takes 15, 20 minutes to file it.
Yeah.
I understand some people are upset and they didn't want to file it because it was invasion of privacy.
Well,
and I do feel that way.
Yeah,
so
well,
I support the ones that don't.
And the department that's capturing the data is where my problem is. FinCEN is a crime collection agency for fraud.
Yeah.
Okay?
Yep.
They are not, it's not like reporting it to a division of Congress that handles small businesses.
Yeah.
This is a collection agency for fraud, embezzlement, restitution. They handle fraud cases.
Yep.
And all of a sudden, every LLC owner in America is now dealing with a collection agency.
Yeah.
That was my issue with it.
Yeah, and that's why I support my clients who don't want to file it, because if it changes, the good news is we're on high alert. So we're prepared to have an email blast go out to all of our clients who haven't filed it to say, hey, this has been undone now, and we have 30 days. Because if it gets undone, it's going to be a pretty immediate filing. So so for the reasons you just mentioned, a lot of people have chose not to share that information with this division.
Yes.
And then other people are like, I just want it off my plate. And that is just more of a personal preference. But up until 2 weeks ago, it wasn't an option.
It was not
and
an
now
option.
it is an option. And if you don't want to file it, you're not going to have any recourse at this time.
Got it. Okay. What do you have a feeling about this? Like, where's it going?
I think it's going to get squashed.
You do?
You talked about the administration and
the new administration.
Whether you were happy or not.
Yeah.
Regardless of how people feel, I think for businesses, for us financially, for these types of reports, I see them more getting squashed than actually.
You think the Trump administration steps in on this injunction, and does the executive branch have any authority in this, or is this a different article of the government that's got to deal with this?
I'm not sure, but I would assume that if he can step in, my belief would be he will, and he'll squash this thing. I personally feel it will go away. And that's why when I talk to my clients, half of them are just saying, well, I've paid for it. I want to just go ahead and do it.
Yeah.
And then the other half are like, no, if I don't have to do it, I'm not going to share this information. And that is a personal preference.
Yeah, it's a database entry that you may not. It's kind of like, do you really want somebody to have your DNA?
Yeah.
Yeah. It's
because you don't know what they're going to do with it.
It's so personal, right? I mean, you just got to make a decision that's in your best interest. Yeah. So I think I agree with that feeling that it probably will get squished.
Yeah.
All right. So now we're going to switch gears now. So is there any other federal reporting we've got to do other than the IRS with our LLCs?
No. So all we have to do every year, except the state of Arizona, believe it or not, Arizona LLCs, once you set one up, you never have to renew it again. It's the only state like that.
Interesting.
You don't have to renew it. It's bizarre. Their driver's license even goes 50 years. They got some unique rules.
Yeah, they do.
But every other state, you have to file an annual report.
Okay.
So for example, in Wyoming, it's $52 a year to file an annual report.
Okay.
But there's no taxes there. So as I was touching on a little bit earlier, you have these simple fees, a few $100s typically to maintain an LLC in that state.
Yeah.
You're still going to pay your taxes on your personal taxes wherever you live. So if you're a Californian or in Arizona, none of this changes all that. This is all for asset protection purposes only.
I got you.
But so the once a year, we'll have to help them with the renewal of the entity, and then obviously file the taxes or an extension, and then have them handled by September 15th or October 15th, I should say, every year.
Got it. So I followed very closely the 15.3% savings.
Yes.
And that seems like a huge reason to do this. There are tax reasons as well to set up an LLC, like deductions, if you will, some corporate expenses. Go through just the ones that may be in your head that you know are somewhat common that the audience may not be familiar with. Like, because as opposed to being an employee at Microsoft, where they're zapping my taxes and my Social Security and my self-employment and all that stuff right out of my paycheck. They're pulling Social Security right out of the paycheck. They call it FICA, I think. They're just pulling all that out. An LLC, that stuff's not being automatically vacuumed out of my paycheck.
Just out of your W-2, whatever you pay yourself.
That's right.
That's
or
correct.
1099. It's just not coming out that way.
Yeah.
So these deductions are really between me and my tax preparer to consult on expenses I may have had throughout the year to generate the business I had.
Correct.
So let's talk about what some of those are, like categories.
Yeah. Well, one thing that's really important that everyone should have now in their hand is a tax planner.
Okay.
That's my feeling. Our clients will have a tax planner in December to make sure they know all the different deductions and write-offs.
What do you mean a tax planner?
Like
What do
it
you
has
mean?
all the different vehicle, reimbursed expenses, basically every line item that they should be considering writing off through
Where
their
would
business.
I get a tax planner?
Yeah, from Corporate Capital or whoever your CPA is.
Got it.
So once you become a client of ours, as an example,
Yes.
we give them a tax planner, and then we roll up our sleeves and try to identify everything we can before December 31st. Because
What's on this tax planner?
Yeah.
Give me some of the ideas.
So we'll put on there vehicles, a telephone, a home office.
When you say vehicles, you mean I can deduct my car lease?
Yeah, you could deduct your car. If your car's over 6,000 pounds, there's some unique deductions for vehicles.
Like if it's a Yukon or a Suburban or something, these things have a different farm equipment type deduction?
Depending on the weight of them, yes. But you could always depreciate your vehicle and a certain percentage. So there's apps out there like Mileage IQ. So if you are using your vehicle for business, you want to make sure you have an app. So if I'm driving to Green Valley to do a podcast and I'm writing off my vehicle, then I'm keeping track of that. So on this planner, we'll have all the different deductions that you should know as a business owner are available to you.
So throughout the year, I'm keeping dry cleaning.
Yeah.
Business lunches.
Business lunches.
Corporate travel.
Yep.
Purchase of luggage.
Yep.
How about a percentage of my home that I dedicate to my office?
Yes, you can do that. Also reimburse expenses. I do reimburse expenses through my company.
Okay.
But the home office deduction, I'm glad you brought that up.
Yeah.
Because a lot of people will just take the home office deduction on their taxes because that's what their CPA or accountant knows.
Yeah.
That home office deduction does not come close to what this Augusta rule, this tax strategy that you can implement that is better than the home office deduction.
Okay, let's talk about this. So normally, let's break down what the home office deduction is first.
Okay.
So the home office deduction is it up to 25% of the square footage of my home? How does it work?
It's actually supposed to be the exact square footage of the room that you use.
Okay.
So if you're using a room that's 500 square feet in a 4,000 square foot house, you are only supposed to be able to write off that percentage.
All
if
right.
that makes
Now,
sense.
am I adding taxes, homeowners association, my mortgage? Is that whole payment in 500 square feet divided by the total square feet? So it's the whole thing to live in that house.
Yeah, but again, that's why our clients, if they're doing the home office deduction, want to use the biggest room possible.
Sure.
But you got to be careful, and there's usually a cap on that home office
That's
deduction.
what I'm wondering. And because I got a guy that mows the grass too, and I plant flowers quarterly, and there's a lot of cost to make my office look right.
Yeah. Yeah, and
am I getting all that deducted?
See, and if you that's when you have a good relationship with your CPA and we know what your goals are.
Yeah,
like we want to take a look over and we'll push ourselves up against the fence. We don't want to push you over the cliff, but we want you to take a look and we want to make sure that you know all your options. And ultimate, like I had a client last year, James. We broke down a scenario where we could have saved him $14,000, but it would have taken a little bit of time on his end. And he said, you know what, I'm just going to pay the IRS $14,000. I was flabbergasted because it literally would have taken him 4 or 5 hours, but his time was worth more than that.
Yeah, I get that.
Yeah.
I totally get that.
Yeah.
Okay, so that's the home office deductions tied to the square footage I use within my home.
Correct.
All right. So I could need a lot of elbow room, or I could be in a closet.
Correct.
Okay. Now let's talk about this thing you just referred to as the Augusta rule, and you're referring to Augusta, Georgia.
Yeah.
And something that was designed.
That sweatshirt you're wearing right there, sir.
Oh, yeah. You're right. The sweater. That's the logo. So we know about Augusta. We both golf, right? We understand that Augusta, Georgia, those people vacate that city and rent their homes out a couple of weeks a year. And that's in many cases, their livelihood. And people come into Augusta to attend the Masters golf tournament and use those homes and those swimming pools and those barbecues while those folks have gone on their annual vacation. Mm-hmm. And so this is the impetus of the Augusta rule, right?
Yeah, this is where it started. So it started in Augusta, Georgia.
Right.
The good old boys got together.
Yeah.
They had plenty of money, assets all over the country.
Right.
They were going to watch the golf tournament. They found out a way to implement a strategy that the IRS approved where there's a cap on it, though. So 14 times a year, you can have a meeting at your. It doesn't have to be a place in Augusta, Georgia, or a rental.
It's called the Augusta Rule.
It's called the Augusta Rule.
It could be in Macon, Georgia.
Yeah,
it could be in Tennessee.
And so 14 times a year, I do the Augusta Rule.
Okay.
And I've been doing it for 6 years now. So I'll pay myself $2,000. So the national average, and we have all the comps from across the country.
Okay.
So like the Empire State Building, the Bellagio, the Wynn, Del Frisco Steakhouse.
Okay.
So the national average to have a meeting is $2,000.
Okay.
So instead of
for a week?
1 day.
Oh, for a day.
For that meeting.
Okay. Oh, wow.
So instead of you going to Del Frisco's and paying $2,000 and James and me and my staff comes, we can do it at my house, which is free.
Yes.
I am legally allowed to pay myself 14 times over the year, $2,000 per meeting.
Okay.
That comes off the bottom line of my company.
Okay.
So let's say in 2023 there were 3 partners. That's an $84,000 expense for my corporation.
That's 28,000 times 3.
28,000 for each partner,
Yeah.
and we didn't have to claim a penny of that on our income tax return, and that's why it far outweighs the home office deduction.
Okay. We're gonna back up a little bit on this because I followed it, but I just want to make sure I didn't exaggerate some of these benefits.
Okay.
You did 28 times 3 because you got 3 people sitting in the house for the meeting. They're dragging that benefit back to their return, not yours.
Yeah, it's
for you.
Yeah, so let me explain. That
Yes.
28,000 that gets 14 times a year. There's a check written to let's say myself or my wife.
Yes.
All right, and then we'll hold
From your company bank account.
from corporate capital.
Yes.
Directly into our personal name.
Okay.
And then we do meeting minutes to show that we held a meeting at the house, but it's just me and my wife. It doesn't have to be the other partners.
Yeah.
And then I'm able to give myself $2,000 14 times a year. And the reason the IRS put a cap on it is those who could take advantage of it. I'd do it 50 times a year if I could.
Sure.
You know?
Yeah, right. So the reason you said 3 is because your partners who are also in that meeting, they get to take that same benefit back to their house?
Yeah, no, they're having their own separate meetings at their house.
Got it.
They're not even part of my meeting. So every partner is running their own show, and it's kind of a technicality.
I got it. So a loophole.
Yeah, and
it's a loophole.
Everyone should take advantage of it. It's $28,000 that I'm not putting on my tax return.
And this is right in the Internal Revenue Code.
Absolutely.
It's called the Augusta Rule.
Yeah, otherwise I wouldn't be talking about it in front of all your staff and audience.
Right, of course. So interesting. So let's break this down for a second. That 28,000, that's not a tax credit. That's coming off the AGI? Mm-hmm. Okay.
Yes.
So
it doesn't even exist at the end of the year.
Okay, so the adjusted gross income, let's say it's $800,000, the adjusted gross income. So 28's coming off the 800.
Yeah, so now we're at 860 or 768.
Okay, so 760
or 762 or whatever it is.
Yeah, it's 28 less than 800. So ultimately, we're not building tax credits here because those are available too in different areas. This is literally a deduction from my annual gross income, not recognized as income at all. It's a deduction.
That's correct.
Yeah.
And you don't have to claim a dollar. I put every penny in America First every year, and I do not have to put that on my 1040 tax return.
I love it. Okay. And I think it's the reason I slowed down on that is because a lot of people get confused between tax credits and deductions.
Sure.
Right?
Yeah.
One is the money we owe the IRS, and we're pulling money off that. Like an EV credit of $7,500 is literally a tax credit.
Correct.
It's not a deduction.
Yeah. It's like solar and things like that.
It's different.
Yeah.
That's very different. Now, while we're on taxes for just a minute, I know you have partners that are tax specialists.
Sure.
But this is general conversation about taxes because I think the audience will benefit from this. A lot of people get confused when we talk about income tax, and they think their state regulates the income tax. And of course, their state has an income tax, but there's also a federal income tax.
Correct.
And so you have to add the two together.
Correct.
To figure out what you owe.
Correct.
So as an example, California may be 14%.
Yes, I was going to use California.
You may owe 36 based on your income level federally. So we're talking about 50% of the income is taxable.
Yeah.
I mean, literally, we're going to create a tax off that. Now, that's ordinary income taxes. This is where I find a lot of folks, and I mean a lot, I would say over 50% of folks, when you say capital gains or income tax, they think that's the same thing. Let's talk for a second about what is a capital gain tax versus an ordinary income tax?
Yeah, the ordinary income tax, like working for a company or being an entrepreneur, like that's ordinary income. But
Right.
when we have investments and rental properties,
Right.
and
Stocks,
and
cryptocurrency.
yeah, we're gonna be making capital on that, and so you have to pay capital gains tax on that.
Okay.
So there's ways around capital gains tax, which we could talk about a little bit.
Let's talk about the tax itself first,
Okay.
then we can talk about the ways around it.
Okay.
We know capital gains tax is not as high as ordinary income tax. It goes as high as 20%.
It's 15, yeah, 20%.
Yeah, as high as 20. It can be lower.
At 10,
it
sometimes.
can be
yeah.
lower, but ordinary income tax can go up to 36.4 or whatever. It's high.
Yeah.
But capital gains. Why do you think philosophically the federal government has decided that capital gains should be taxed lower than ordinary income?
You know, you think that they would try to tax it the same. I don't know if they're trying to help people because people are frustrated with the capital gains and trying to avoid.
I have a thought.
I'd love to hear it.
I have a thought on it.
Yeah.
A capital gain, the reason it's taxed lower, this is just my opinion. I've never heard anybody talk about this, but it's actually risk capital. It's at risk.
That's true.
My job is not necessarily at risk. I'm going to be paid to put in the time and the work and the effort. I'm trading my time for dollars.
Yeah.
But when I put in money on a rental property, tear it down and rebuild it and put new cabinets in, that's risk capital that I may not recover.
That's correct.
And so if there is a gain, they're going to tax me less because I put money at risk to make that happen.
Yeah.
And I think philosophically that's what that's about.
Yep.
Like with stocks. I do a little bit of stock trading, right? I've got a portfolio. And so when I have a gain there, and I think this is an important distinction for the audience, every dollar you make in the stock market is not a gain. Because your money's in there too.
Yeah.
Let's say you started with $100 and you made 120. Well, only 20 of that is going to be taxed in capital gains tax. The 100's what I put in.
Correct.
They call that my cost basis.
Mm-hmm.
So it's the same with the house, right? I bought the house for $500,000.
Yep.
I sold it for $600. I don't owe tax on $600.
No, just 100.
Right. And if I put a big lawn in, I put a fountain in, I put a pool in, I put the landscaping in, I may have put in $600.
Yeah.
Right? So I may have no taxation.
That's correct.
Right. Okay, now let's talk about how to avoid or minimize. Maybe that's a better word than avoid. How do we minimize capital gains tax? What are some of the things we can do?
Well, depending on the asset, like if we talk about real estate, you can.
There's a big audience with us that do rental income properties. A lot of folks do that.
Do they?
Yeah, a lot of folks watching the podcast are playing Monopoly with rental properties.
Okay.
So let's use those examples. How can they minimize capital gains with real estate portfolio?
Yeah. So with the 1031 exchange is one that's been around for forever.
Tell us about this.
And the 1031 exchange basically is you're taking the money from that property.
Okay.
And let's say you sell it for $800,000.
I put in 5, I sell it for 8.
Yeah. Now if
I would owe 300, or 300 is taxable.
Yeah, 300 is taxable.
Right.
Okay.
Unless
you do a 1031 exchange where as long as you put all of that back into the next property,
roll it over. Okay.
It's not taxable at that time.
Is 1031 the actual Internal Revenue Code number?
1031 exchange, I'm not sure about that.
I think it is. I think 1031 is the reason I know that is from financial services. 1035 is how you roll over an annuity gain or a life insurance gain when you move it to a new policy, or that you do use a 1035.
Well, let me tell you about that. So with a 1031 exchange, I just talked to a guy yesterday who's dealing with this. So we're looking at a charitable remainder trust, which we can talk about, which is another option. But you have to have an intermediary for a 1031 exchange. So basically, that money never touches
my hands,
your hands, the audience's
All right,
hands.
I'm selling the house.
It's going to an intermediary. They're holding the money, and then they're going to make sure that goes.
When you say
for
an
the next
intermediary,
purchase.
you mean like a trust account or an escrow account?
Yeah, the companies that specialize in that.
Okay, so it needs to sit there. The proceeds need to sit there because if I have access to them, it's a taxable event.
That's correct.
Okay, so.
And you pay the capital gains tax.
How much time do I have to select my new location to roll over my proceeds?
I'd say probably 30 days. You need to proactively plan ahead. 30 days, start the 1031 exchange process.
Got it. And am I communicating with the IRS that, hey, listen, The reason you don't have your tax proceeds is I'm doing a 1031.
Yeah, we do that for
got it.
Yeah, we do that for our clients or your accountant. Or
It's a form
anyone's. Yeah,
that goes in the IRS that puts them on notice.
that's correct.
The reason you don't have this man's taxes
It's
is 'cause
recognized.
he's rolling it over.
It's recognized, but he did not take any of the proceeds. He
Okay.
put it into another investment, and then they know that they're probably going to deal with it 5-10 years down the road, or however long you guys decide to keep your property.
You brought up something there as a strategy, which I know a little bit about. I've seen these put in place, and it's really a nice strategy. It's complicated, so let's move slowly as we go through it. But charitable remainder trust, or sometimes referred to as CRTs, is a way to avoid or completely eliminate a tax obligation when you've had one of these gains. Let's say I don't want to buy another piece of property, and I've got $1 million gain, and I'm either going to pay 20%, $200,000 on this $1 million gain, or I can perhaps deploy what they call a charitable remainder trust to avoid this. Tell me a little bit about how a CRT works.
Yeah, I mean, and with your charitable remainder trust, you can do with it what you want. I mean, sometimes you're a little limited as far as the personal benefit from it because it is set up to give to charity or your children.
So I select a charity.
Yep, you select a charity.
Let's say it's my church.
Yeah.
Okay. So I select my church. Am I giving them just the gain, or am I giving them the whole rollover?
No, it's the gain and
The $1 million bucks?
the gain.
Okay.
Is the
Okay.
300,000 in this example is
Got
what you're
it.
talking about
So
being taxed on.
So they get the 300,000.
They would get and
The
then
church.
and then the 500,000 technically because
come to me.
that was the original investment.
My cost basis.
Yeah,
It can come to me.
That can come back to you. But with a charitable remainder trust,
Yep.
I think it's 5%, and this is where my staff, my attorneys
It's
come
okay,
in.
yeah.
I think it's 5% each year. There are some restrictions, and there's some things that you have to follow every single year.
Yeah.
And so because of some of the limits with the charitable
Yeah.
remainder trust, again, it's very unique. I only have a couple clients who have those,
Yeah.
but they want to avoid paying
Yeah.
that $200,000.
Yeah.
And this example I gave with this gentleman the other day, he's going to take out so much over the years,
Yeah.
and then he'll be taxed on that, but he doesn't want to get taxed on the full amount right now.
Right. Here's where I've seen it done, Brent. And if I say anything that's off, you're the expert here. But this is where I've seen it done in financial services. The CRT gets set up. You pick your church. That's where we're going to put the money. But the church doesn't get it yet. You can pick a financial instrument out. Let's say it's an annuity or a CD or a stock portfolio even. The beneficiary of that selection, that financial instrument, is the church. They're the owner and the beneficiary. The income that spends off of that instrument that we selected, church is on notice, the IRS is on notice. They both know that it's coming to the church, but not till I die.
Yeah.
And so the income that can spin off that CRT belongs to me and my family until I die.
That's correct.
And so basically, I could, in fact, have an income from the 300 grand or whatever the gain was. In some cases, it's much larger. And I get the benefit of the charitable deduction on my taxes.
Yep.
You're right.
And
Right
still
away.
help control my money.
And I have the income power of the money.
Yeah.
Which is really all I wanted anyway.
Yeah.
Nobody's got 200,000 in the mattress, I hope.
Yeah.
You usually put it somewhere and try to pull income from it.
Yeah.
And that's usually what we do with financial services. We try to find a destination for your pile and then pull income from the pile.
Yes.
And so the charitable remainder trust allows you to put it in a pile that you can't get to at death. The charity's going to get it, but in life you get the rest of it and the benefit. So that's the CRT, and I love it.
Yeah. And those are the two most common. There are some other strategies that you can implement, and what we typically like to do at that point in time is our head CPA Josh McLean.
Yes.
As I've told you, more than happy to do a consultation with your group and just have that conversation to
Right.
see if a charitable remainder trust makes sense or if they should do a 1031 exchange.
Right.
But I just encourage people to plan ahead, whether it's your family and your living trust or whether it's the taxes, whether it's all these things we're talking about. Just plan and be proactive.
Right.
And if you have questions, ask those questions and hook up with Guy times, like James or
Yeah.
your local accountant or CPA. I tell people this: if they're not bringing up some of these strategies,
Yeah.
like corporate strategies, protection, low-hanging fruit, tax
Yes.
things you can implement,
Yeah.
then we're making a big mistake.
Right.
I want to go back to that for 1 second,
Yes.
because one other thing that people should do before the end of the year, if you're sitting there with a business that has a lot of profit at the end of the year. I currently have 4 boys. So I have 3 boys that are under 18. And I love sharing this because, again, I don't care who watches it.
Yeah.
I pay my kids from corporate capital. I have a business called the Carlson Family Circus because I have
Okay.
4 dogs, 4 boys.
It's a circus.
I call it the shit show.
Yeah, right, right. Good.
So I have the Carlson Family Circus that every month gets about $31.75 or so direct from the corporate capital into my LLC.
Okay.
So then I go to America First Credit Union on the first of the month. I put it into the Carlson Family Circus. That money gets transferred to Giovanni, Cole, and Carter, my 3 kids that are under 18.
Okay.
I pay them $14,000 a year this year. Last year was $13,700. The year before that, $13,000, then $12,000.
Okay.
But every year I've done that.
It's an IRS limit.
IRS limit. So unless you make more than $14,000 in 2024,
Yeah.
you don't have to file a tax return.
Okay. So we keep it under the filing requirement.
Correct.
How does it benefit your LLC?
So corporate capital, with this example,
Yeah.
with 3 partners in 2020, let's say that's a $42,000
Yeah.
deduction for my family,
Yeah.
right? $14,000 per child.
Yes.
So now corporate capital had a $126,000 deduction that we did not have to pay taxes on. It's
Okay.
the same scenario as the Augusta rule,
Okay.
where that money goes
Okay.
into your family. And I literally take the money from their account and transfer it back into my money market account,
Okay.
because I legally can do that.
Yeah. The custodian of their accounts.
And my
Yeah.
son bought his own little Lexus last year. He drove to Utah and bought a little Lexus with the money
Yeah.
I've been paying him over the years. But
Yeah.
instead of that money going to dad and me getting taxed 35%,
Right.
he would have only had $6,500. I would have only had $6,500 of this $10,000 vehicle.
Yeah.
He had all full 10 because I kept him under that threshold. So if any of you have businesses,
right.
and if you're dealing with what a lot of us deal with, that having the profit at the end of the year, look at those things to minimize. And
Well,
there's
these are amazing strategies.
my CPA did mention this to me prior to coming.
Yeah.
I'm not prepared to talk about it.
Yeah.
But there's some new things he learned this year with medical reimbursement that's brand new as well.
Okay.
So if you're in a position where you have medical bills that are outrageous,
Yeah.
I would recommend looking into that, doing some research, or even giving us a call, and I
very
would
good.
connect you directly with Josh on that.
Yeah, I'm gonna press you just to touch on it, and if you don't know the answer, you don't know the answer.
Okay.
But it's because I'm curious personally, related to medical.
Okay.
Did it sound like a credit or a deduction?
It sounds like a deduction.
Okay, all right.
Yeah,
Yeah,
sound
most
like
things are deductions.
it sound like a
Credits
deduction.
are like rare air.
Yeah, and we've learned more about that too. I mean, I've been in business 11 years. I've been in
Yeah.
the industry 20 years. But this is I got off a call earlier this morning talking about tax credits, and
Yeah.
part of what we're going to do with that client with this charitable remainder trust is look at purchasing tax credits. Now, I don't know a lot personally about
Sure.
the tax credits,
Yeah.
but that is something that is more and more popular. And
Oh, yeah.
what Josh found out just from his CTA, because he takes the continuing education every
Sure.
year, he came skipping down the hall because he was so excited about this medical. So I can't
Okay.
wait to learn about
that's
it.
good.
But
we'll have to have you back to,
Yeah.
to cover that. That's really good. Really good. Okay, as we get near the end here, I don't want to let you leave without talking about the power of a living trust.
Okay.
Living trust, there's 2 types, revocable and irrevocable.
That's correct.
And then in lieu of those 2, someone might have a will.
Yes.
Many people have nothing, right? So, as by way of setting up this question, when we're thinking about passing our assets to our children, we have the choice to do nothing and kind of let the court step in, and I think they call that intestate, where they have to figure out and sort out and referee what you got and what you don't have.
Yep.
And they charge you for all of it. They
Yep.
take the money from your kids, basically, and assign trustees and court officers and everything else to it. And then they have to appraise it, and then so your kids get less, bottom line. So that's intestate. That's an irresponsible situation. Then there's the will, which sounds like the mature way to handle things. But you and I know differently.
Yep.
What happens to the estate if I just have a will?
I really appreciate you asking that question, because a lot of people will see commercials. You see them all the time here in Las Vegas.
Yeah.
Come set up a will for $99 or $4.99.
Yeah, there's a reason they're cheap.
There's a reason they're charging you, and they encourage a will. A will will still go through probate court in every state.
Yeah.
So what happens is you go to that attorney and you pay him $4.99 for a will, and then you end up passing away in your family. Like my cousin last year, his mom and dad both died.
Yeah.
They had one home. They didn't own a business. They didn't have a bank account.
Yeah, they had the house.
He called 23 law firms. $10,000 retainer was the cheapest he could find. Long story short, they foreclosed on the home. He lost his $10,000, and if his parents would have had a living trust
instead of a will,
then it would have gone to, because a will will still go through probate court.
Right.
So
well, it's required. There's no way around it.
Well, but if you have a living trust and you have a will, you can avoid the probate court. So inside of the will will focus on your beneficiaries. Like I have 4 boys. My wife and boys are getting everything.
Yeah.
But if I just simply had a will, they would have to go and probably spend $20,000-$30,000 retainer
100%
to have my business, my asset, the building I own, my resident, everything go through probate.
That's why the will's $99.
Yeah.
Because the money
doesn't do anything for you.
The money comes when you hire him to do the probate.
Correct.
Right. Now, by the way, something I learned about wills, and then we're going to move into living trust.
Yeah.
You open the safe up at your house and look at your will. It's a copy. The actual will, with the stamping and all the proper seals on it, is in the lawyer's safe.
Yeah.
So you have to go back to the firm and find that will. And if you cannot get that original will to go through probate, you're intestate. I'm sorry.
Yeah.
The original will is sitting in the law firm's. By the way, they value the law firms tied exactly to how many wills they have to probate. That's how you value a law firm that does estate planning. That's part of the valuation. So I know firsthand the power of a living trust, and everybody in my family's got a living trust. You don't have to be wealthy to have a living trust.
No.
There's a perception, I think, that you have to have wealth to have a living trust. Tell us about living trust.
You know, it's so funny you say that, because people really feel that way.
I know.
And I'm starting to change their thinking a lot with my conversations, because a living trust is something that you never really have to update or change. You just always want to make sure your beneficiaries are current.
Right.
But as far as like my parents having one from the 90s, I don't have to update that every 10 years. We just have to make sure that everything that we have in our name in title, whether it's a vehicle, whether it's our personal residence, whether it's our bank accounts, if it has title and it stays in James or Brent's name, it's going to go through probate. So inside of a living trust, you have 3 main components. You have the power of attorney, which is very important in the event that you can't make decisions and someone needs to have power of attorney. You have a legal document that shows that this individual can make these decisions. You have your health care derivative in there.
Whether you're going to keep me alive.
Yeah, and I have in my living trust that I don't want to be a vegetable. I actually decided against that.
You want to be unplugged.
Yeah, so I want to be unplugged. That was my choice.
That's a personal choice,
Yeah, everyone has their own personal choice, but at least I get to control that choice instead of some doctor or judge or attorney.
Policy.
Yeah. So, and then the third component is you have that last will and testament is part of a living trust. So now that your will is inside of a living trust, you do not have to worry about the probate process anymore.
It skips probate.
It skips probate.
No judge is involved in my estate.
No, because your will was inside of a living trust.
Okay, so I'm gonna use just not legal terms but regular terms, and you fix anything I say that's off.
No problem.
It sounds to me like the living trust allows me to govern my estate while I'm alive and after I'm dead.
Correct.
Is that the best way to look at it? I can govern it. As opposed to, I hope they can get this sorted out because I'm not here anymore. I hope my kids can sort this out. I hope they don't fight like they used to fight.
They're going to fight. I've seen it.
They're going to fight.
They're going to fight.
They're going to fight. Everybody thinks their kids are going to delicately, reverently handle the burial and the grieving process, when in reality, if you haven't bothered to sort it out with a living trust, it's going to be chaos on your family. Now, here's the other thing that I've heard about a living trust. This is why I did mine. I get to pick who gets what, and I may have a special needs child. Okay? And in that scenario, I can actually designate he's not going to get his portion until he's either got someone that can help him, or he's old enough and has outgrown this special need, and maybe it's his wife or something. But I can actually lay all that out in the living trust because I know his situation.
Absolutely.
Right? So as opposed to, gosh, what's he going to do with his 1/6 or whatever? It's going to be crazy. And the other thing that made me really motivated to do a living trust was the idea that, like you said, when I go open a bank account now, it's not the James Catledge bank account.
Yeah.
It's the James Catledge living trust with the date
Yes.
that it was open. And the bank doesn't get to see my trust. They see the certificate of trust, which tells them the title of it and the name of it. They don't get the details of my special needs child at the bank when we open it. They simply get what we call a certificate of trust, which is a summary of who gets to open this bank account.
That's correct.
Yeah.
That's exactly
And I
right.
love that.
Yeah. And one other thing I want to point out, too, for those who are very, very successful, who may have some infinite banking type policies, whole life policies, inside this trust, we typically will offer to put dynasty family bank language. So a lot of people have a living trust that when they die, all their assets just go to their spouse or their beneficiaries. I have mine set up to where my kids, because I still have 3 under 18.
Yeah.
That's why I'm paying them.
Yeah.
So I have so much that they're going to get when they turn 18, 21, 25, and 35.
Okay.
So I actually spread it out quite a bit because I know how mature I was when I was 18 compared to 43.
Sure.
So I wanted to make sure, just my responsibility as a dad. Obviously, I'm going to be able to provide my kids a very nice future, but I don't want them to have $1 million or a couple $1 million when they're 18 or 21.
Yeah.
Now, I don't plan on going anywhere, but I had a client last year, 44 years old, worth $11 million, San Diego, passed away. His wife called, very upset.
Wow.
Luckily, we had those documents that you talked about. We had the living trust done, so she was able to go to the bank and get all the funds released. She was able to go to the title company. And I have to share this with the audience because this is what it's about. I have a lady currently who is waiting on $440,000 to be released from U.S. Bank. It's been 6 months. But
We're waiting on probate.
Because the husband did not have a living trust and he was the only one on the bank account, she wasn't even listed as a death beneficiary. That's what they're going through. So you can avoid all of this headaches in business with the IRS and your estate by just doing it and addressing it right.
That's good. The other thing I've heard in this nightmare scenario where you think you've put a beneficiary down on your bank account and you think they're going to walk in with your death certificate and get those proceeds.
It's not that easy.
No, the judge has ultimate authority over that bank account and assigns a receiver to that bank account because you may owe the taxes. You may owe some taxes. And until they've determined, and by the way, here's the other thing. You owe Visa and American Express too. And oh, by the way, you probably have, Cox probably got some old bills, some internet stuff you hadn't paid. And guess where they show up? Probate's a public process. So everybody you've ever owed anything to, and probably people you don't,
I'm so glad you brought that
are
up.
sitting in probate.
I'm not
Go
kidding.
ahead.
I've had clients with people they hadn't seen in years or ex-spouses show up.
Absolutely.
Of divorce 10 years.
They read in the paper that
took
James
advantage of it.
Catledge has died, and they go, oh, well, boy, they're going to be a probate
So
there.
Wild Wild West. We'll see what happens.
Yes. Take your chances. And there may be some old debts you owe. There may be some old finagling you did with a partnership or something. Some of that stuff may be there.
Yeah.
Well, a living trust, you can skip all that stuff because
Yeah.
it's not a public process.
Yeah, and you don't have to record it. It's all private document. We keep a copy for our clients, and then we always add like the kids' information to the account. So if the parents do pass, they're able to call and say, "Hey, this is Johnny. James.
We got Johnny right here."
And then we have him listed. So then we will help with that process because the grieving process is very difficult. And if I may, just for 5 minutes,
please.
I just want to give the audience something to do some research on.
Yeah.
Nevada has something known as a Nevada Asset Protection Trust.
Okay.
It's an irrevocable trust that allows revocable privileges.
This is different than a living trust.
This is different than a living trust, so I want to explain that. So a living trust does not have any asset protection.
Okay.
So anything that is inside of our living trust can actually be taken from us while we're alive.
In a lawsuit.
In a lawsuit.
I got it.
So if you are here in Nevada or California, homestead your property because in Nevada it's $630,000 for a married couple, same as California.
Okay.
So homestead means the state will protect $630,000 of equity in your personal
from
residence.
litigation risk. Yeah.
So that's the only way you can protect your personal residence.
Okay.
Now, any other businesses that you have or investments or rental properties or policies, you can put into this irrevocable asset protection trust.
Okay.
It's called DAP, the Domestic Asset Protection Trust,
Okay.
specifically to Nevada.
Wow.
Every asset that's inside of this trust is protected from any creditor or any litigator after a 2-year look-back period.
Okay.
So I have the stock of my company inside of my asset protection
Brilliant.
trust instead of in my personal name. So if Brent Carlson gets sued, I don't have the stock of a multi-million-dollar business.
Yes.
It's inside of my estate. So this irrevocable trust is very good for policies, cash, guns, business interest,
Okay.
anything that you're really looking to protect and
Yeah.
hold on to long term. And that's as simple as I can make it.
Let's talk about the irrevocable nature of it.
Yeah.
Let's say it's a stock account.
Okay.
You got your stocks in an irrevocable trust.
Yeah.
Can you close the account?
Yeah, you can close the account. You could, but
So what's the irrevocable part, I guess?
So I guess you're not closing it. You can take the assets out, I should say.
Okay.
So every asset that's inside of that trust, you could transfer out. So
Okay.
for example, I had land in mine in the 2010-11.
Yeah.
When COVID hit, I took it out, refinanced it, and then put it back in.
Got it.
So once you put the asset in,
Yeah.
the 2 years starts over though. I
Oh,
want to
I
make
got
that
you.
very clear.
Yeah, I got you.
So that's why you have the flexibility. Now, with an irrevocable trust,
Yep.
you typically can't change the grantor
Okay.
and the beneficiary.
All right. Grantor's the one who sets it up, the owner.
That's correct.
Okay.
So the grantor is the owner of the
Yeah,
trust.
right.
And then the beneficiary of this specific trust,
Yep.
we want to make that revocable living trust because you can't change the beneficiary
Interesting.
of an irrevocable trust.
Interesting. So you make the beneficiary the living trust.
Because you can change that beneficiary anytime you want.
That's brilliant. Good,
And that's
good,
what we do.
Good strategy.
Yeah.
Well, I like that. Brent, this has been fantastic.
I've enjoyed it.
Man, you got a lot on your mind, brother, and we need more of it. I hope you'll take an invitation to come back and talk to us more about this stuff. And maybe when we get to this BOI, figured out beneficial ownership interest, whether the feds are going to make us report on these LLCs, maybe we come back and have you make that announcement right here.
Well, you know what else I'd like to do is next time I come back, I'll
Yeah.
come back with either Lenny, who is our head CPA
Okay.
and attorney,
Okay.
or Josh McLean, who's a head CPA of another division within my company.
That'd be great.
But I'd love to bring one of them with me, and your audience can get to know them as well.
That's great. You're really a helpful resource to us, and I appreciate our friendship and you
Yes.
being here today.
Of course, I appreciate it as well. Thanks, James.
Thank you.